Hey, what's up guys? John here. Citigroup is warning their bond traders that interest rates could very well increase.
Inflation actually continuing to come in stronger. That's the basic macroeconomic problem that the Fed faces. You lower interest rates, that's going to support the economy, but that's also going to boost inflation.
The complete opposite of what hundreds of millions of Americans are expecting in March. They're thinking we're going to see a 25 or 50 basis point decrease. But when you start looking at the data and you start looking at what Jerome Powell has been saying,
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting. Probably not the most likely case.
What you can see is one thing, and one thing very, very, very clearly, that things are going to get a lot harder in America and the cost to borrow money is going to greatly increase. It might seem hard to believe, but I'm going to show you the facts. I'm going to show you exactly what's going on, because if you're positioned with the right information, you'll be able to make money in an environment where most people are going to be losing their shirts. I'm going to break it down for you. I'm going to give you the facts and show you exactly what's happening. Please hit the like button, YouTube will share the content, educate more people about what's going on in America's economy. And if you'd like to fix your credit to position yourself for the greatest wealth transfer in American history, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description just below this video and schedule a free strategy session for Monday. Take a look at this. So bond traders need to price in risk of future Fed hikes from Citigroup. Then Citigroup cut 20,000 employees. That came out roughly a month ago. Then today, wholesale inflation accelerates more than expected in January. Labor Department releases closely watched wholesale inflation data. Inflation at the wholesale level rose much more than expected in January, underscoring the challenge of taming price pressures within the economy. The Labor Department said Friday that its producer price index, which measures inflation at the wholesale level before it reaches consumers, jumped 0.3% in January. From the previous month on an annual basis, prices remain up 0.9%. Those figures are both higher than the 0.1% in monthly gain and 0.6% annual figure predicted by Revtin economists. Now, then you look at this. This came out a couple weeks ago. Fed's favorite inflation gauge rose 0.2% in December and was up 2.9% from a year ago. Then the jobs report. When it came out, they were projecting 185,000 jobs, and it came out at 353,000. So they were off 100%. Now look at what Jerome Powell said the path to interest rate cuts will be. He said to dampen the economy, Powell is raising interest rates and withdrawing all the quantitative easing policies that were in place in a more fiscally restrictive environment. Businesses will feel the pain. They will no longer have access to inexpensive funding, and their costs will dramatically increase. One of the intended results is that businesses will enact massive layoffs to cut costs. On a nearly daily basis, companies are announcing layoffs, hiring freezes, announcing attrition without replacement, and rescinding job offers. Powell has been telling the country that he will cause pain by raising interest rates and through quantitative tightening. The problem is that Wall Street and others didn't take him seriously enough. They were betting that he was bluffing and would eventually ease up. After an initial shock from Powell's policies, stocks plunged but later rebounded as investors thought that they were out of the woods. Now, this came out in 2022. He was saying this, talking about what it's going to look like to fight inflation. And he's going to be making all of these sacrifices to, basically impact the job market to pull down consumer spending to combat inflation. And what's happening? The data in which they're showing us is the complete opposite. Saying that, hey, look, sure, you've increased interest rates at the fastest pace in history, but it's not working. And so what are they going to do? Do you think they can cut interest rates now? The answer to that is no. They're not going to cut interest rates now. And so when you look at everything that's going on, Dow falls more than 500 points after January's inflation surprise. Then Jerome Powell says $34 trillion in national debt is ready for an adult conversation. We're spending right now more on gross interest payments than on national defense, right? So when you look at what's going on and where consumers are right now, most property, single-family homes, duplexes, triplexes, fourplexes, small businesses, all owned by, everyday Americans. And everyday Americans are borrowing money and having to refinance their expensive debt in today's environment. They might have borrowed at 2-3% a couple years ago, but a lot of these people are going to have to refinance today. And it's going to be a lot harder to get these loans. It's going to be a lot harder to afford these loans. Like, look for context. Interest rates right now on a credit card, 27.91%. In 2021, it was 16.4%. And in 2008, 13%. So let's say, for example, you have a 13% interest rate on a $10,000 balance, right? You would pay $3,300 in interest if you were to pay $240 a month. Now, based on today's interest rates of 27.91, do you think that it is going to be double? In line with double because it's twice the interest? The answer is no. It goes from $3,374 to $26,000. So an extra $23,000 in just interest expense. So when the Fed increases interest rates and keeps them higher for longer, every minimum payment increases. The length of that minimum payment cycle is going to go on for a very long time. It goes from 12 years, right? Before it was 4 years. So you literally pay for triple the distance. And the same thing is applying right now with mortgage rates. I personally believe we could walk into an environment where mortgage rates are going to be in 9% range, potentially 9.5%. For some borrowers, the average credit score in America is 698. So for, you're basically at 8% right now. And on a $500,000 purchase, 6% down, 30-year fixed rate. And this is with very, very, very low home insurance rates. So you're not getting this in Florida. You're not getting this in, California. It's $4,500 a month. Like, think about that. If you're in Florida and you're, close to $3,000 a year for insurance, the average is like $2,700. But if you're near, near the ocean, you're probably somewhere, north of $3,000. Like almost $5,000 a month if you consider upkeep and maintenance and, being the cost of being a property owner. How many people are going to be able to go out there and afford to buy property? Not many, especially as the job market is starting to soften. And so they tell us that everything is okay, that, consumers, the economy is going to have a soft landing. The big question is how? When nearly 30% of Americans, the top 100 largest metros, are behind on debt payments. 30%. That is absolutely unreal. This is according to LendingTree. 29.6% of Americans in the largest 100 metros were behind on their debt payments between July 1st and September 30th of 2023. These debts include credit cards, auto loans, personal loans, mortgages, student loans, and others. Southern residents are particularly likely to be behind on debt. So you start to look at these numbers and it's so clear why these executives are unloading stock, because they know the entire country is about to go on sale. Nearly 40% of student loan borrowers with their first deadline of October did not make the payments. 40%. Bezos has been just unloading shares. I mean, everyone would have a laugh like that if they were, cashing out $6 billion in stock in 48 hours. Jeff Bezos sells $2 billion in stock at Amazon for the third time this month. Then Amazon, Jeff Bezos sells another $4 billion 2 days ago, right? 3 days ago, he's saving $600 million in capital gains on taxes. So you just look at all of these selling up to 50 million shares by January 1, right? That's almost $9 billion. So he's cashed out. He filed to sell roughly $9 billion worth of stock. He cashed out $6 billion just this week. So it would not surprise me to see him unloading more and more and more shares by the end of the year. And then when you look at what insiders are doing, how does this make any logical sense? If we're not walking into something big in this economy, why are insiders unloading stocks right now? Sure, we're all-time highs in the stock market, but money markets. If you look at 2008, 2009, when there's peak fear, everyone was concerned about bank runs and Lehman Brothers and going down, and all these different problems happening inside of the economy. $3.8 trillion sitting in money markets now. $6.1 trillion sitting on the sidelines. So what I think is very likely going to happen here is going to be the opposite of what a lot of people are thinking. A lot of people are thinking we're going to see a Fed pivot and we're going to have a soft landing. I'm betting that interest rates are going to be much higher for much longer, probably another year, 2 years, maybe even longer than that. I mean, we have over $10 trillion in treasuries that the U.S. needs to sell this year. When you have a lot of countries that are de-dollarizing and selling off treasuries, you have a lot of uncertainty in commercial real estate. A lot of, the small local regional banks, credit unions are in a lot of trouble. They're holding 70% of this commercial debt, and a lot of this debt is underwater. Office buildings nationwide in a lot of big cities, Chicago, Atlanta, Philly, New York City, San Francisco, LA. A lot of the cities that were heavily restricted, 2020 and 2021 pushed out a lot of businesses. These companies, these offices are sitting 18, 20% vacancy rates. I mean, who's holding the bag here? It's going to be these banks, these small banks. So you have all of this weight. As interest rates rise, it doesn't just, impact credit cards credit card payments and mortgages, it impacts the entire financial institution. So what I think is going to happen is we're going to walk into a credit crunch in this country this year. I think things are going to get really interesting, and I think those that are prepared are going to be able to go out there and capitalize on it. I think that's why Bezos and a lot of these billionaires are liquidating right now. They want to sit on a mountain of cash to go out there and buy American infrastructure. Drop below. Let's have a conversation about this. If you'd like to fix your credit to position yourself for this massive wealth transfer, we'd love to help you. Give you a free strategy session at GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, click the link in the description just below this video and schedule a free call for Monday. I'll catch you next one.